Hey everyone, and welcome. In this explainer, we're going to dive into a concept that is absolutely fundamental to accounting, the trial balance.
Now, this is for all of you out there. Whether you're an accounting student hitting the books, a new auditor just starting your career, or even a seasoned professional looking for a quick refresher. A huge thank you for stopping by the Audit Guidebook channel. We're excited you're here for Module 5 of our accounting series.
So what's on the docket for today? First, we'll talk about the accounting backbone. Then we'll introduce the trial balance itself. We'll see how it goes from ledger to balance, talk about when being in balance isn't quite enough, and then we'll wrap it all up with your single most important takeaway.
Okay, let's get right into it. Before we can even begin to talk about a trial balance, we have to start at the source. We have to understand the foundation of it all, the general ledger.
So what in the world is the general ledger, or the GL, as you'll always hear it called? Honestly, the best way to think about it is as the master book of accounts. It's the central hub, the one place where every single financial transaction a company makes eventually lives.
So why is the GL so important? Well, it's not just a list of numbers. It gives you a complete financial story of the company. It's the primary source you need to build those all-important financial statements. And every single journal entry you make, its final home is right here in the GL. It really is the backbone of the entire accounting system.
Okay, so now that we're clear on the general ledger being our foundation, we're ready to bring in the star of today's show, the trial balance. I like to call it the first major checkpoint in the whole accounting cycle.
So what is it exactly? Well, a trial balance is basically an internal report. You take every account from the general ledger, list it out, and show its final debit or credit balance. Its whole job, its entire purpose, is to perform one simple but critical check. Do the total debits equal the total credits?
So why do we do it? Well, its purpose is threefold. First, it's a mathematical check to make sure our double entry system is working. Debits have to equal credits. Second, it's a great first line of defense for catching certain kinds of errors. And third, it's the starting point, the worksheet you use to begin preparing the actual financial statements.
All right, enough with the theory. This stuff always makes more sense when you can actually see it. So let's walk through a quick example of how you build one of these.
Check this out. It's a really simple example, but it shows you everything you need to know. On the left, we've listed out a few accounts. Then, we've put their balances in the correct column. Cash, an asset, has a debit balance. Accounts payable, a liability, has a credit balance. Now, look at the bottom line. That's the magic. The totals match perfectly. $15,000 in debits, $15,000 in credits. We are officially in balance.
So we're in balance. We're good to go, right? Job done? Not so fast. This is where you have to put on your professional skepticism hat. This is a huge lesson for any auditor or accountant. Just because it's balanced doesn't mean it's right.
So let me just ask you that question directly. If you run a trial balance and the debits perfectly equal the credits, are you looking at a perfect set of books? The answer, you might be surprised to hear, is a definite no. A perfectly balanced trial balance can actually hide some pretty serious errors. For example, what if a transaction was just missed entirely, never recorded? Well, the books would still balance. What if you posted a debit to the wrong asset account? The total would still match. Same thing if you used the wrong number for both the debit and the credit. Or if you accidentally recorded the same transaction 2 times. A trial balance will not catch any of those errors.
So let's pull all this together. What does this all mean? What's the real practical role of the trial balance in the grand scheme of accounting and auditing?
If you only remember one single thing from this entire explainer, please let it be this. A trial balance verifies that the books are balanced, but it does not verify that they are correct. That is such a critical distinction. Balanced is just about the math adding up. Correct is about the substance being right.
The best way to think about a trial balance is as a vital diagnostic tool. It's like a doctor checking your pulse and blood pressure. It can tell you right away if something is fundamentally wrong, but it is not a clean bill of health. It's a necessary step for sure, but it is not the final stamp of approval.
Hey, if this explainer helped you get a better handle on what a trial balance is all about, we'd really appreciate it if you'd hit that like button and subscribe to the Audit Guidebook channel. We have tons of other explainers just like this one to help you sharpen your skills.
And I'll leave you with one final question to chew on. After an auditor has looked at the trial balance and confirmed, yup, it's arithmetically in balance, what's the next critical procedure they should perform? Think about it. Thanks so much for watching,
and we'll see you in the next one.